Okay, welcome folks. We are in volume 6 of the Inner Circle Traders Market Maker Collection. We're going to be dealing specifically with the ICT buy model. Okay, and I know majority of my readers and listeners over the last 5 years dealing specifically with Forex. Uh, a lot of the concepts that I use in my trading actually stem from my days as a futures trader. And the market maker profiles actually go back to the latter stages of my commodity trading before I actually made a full segue into foreign exchange and trading spot. But we're going to deal with, again, primarily with the ICT buy model, but we're going to talk a little bit about the ICT sell model as a jigsaw puzzle um, perspective. In other words, how these two models mold together to give you a larger framework of what market structure is doing and how you can blend between the two and really trade without a bias, because I get a lot of questions about, how do I know what bias I should be trading for that particular day or that session or so and so. And a lot of the questions that are sent to me with that vein will be answered between Market Maker 6 and Market Maker 7. Okay, and again, it will not be a complete uh, you know discussion because it will be utilizing these two models in our specific trading concepts portions of this series later in this video series, predominantly the last three of the 12. Now again, if you have been following my work, you'll notice that this is a rather abstract fractal pattern that I have shared with the populace in the foreign exchange universe. Now, again, this is just my quick and dirty way of viewing market structure as it drops down into a level of buying interest for the smart money and what uh, may unfold as subsequent price action from the drop down into a support level. So let's talk about specifically what is an ICT buy model. And the first stage, obviously, when we're looking at this, again, very abstract uh, design, if you will, this area here, beginning on the left side of the overall pattern or model, is the initial consolidation. And this consolidation in the first green box on the left side, okay, is the building blocks of the initial drop lower. Okay, and the second stage is what is referred to as the run to support. Okay, and now what I'm doing is conceptualizing the overall framework of what builds the idea of an ICT buy model. Okay, I'll move down into a support level that will cause some measure of buying and then the subsequent price move higher. The third stage in the overall model is the smart money reversal. Now, 99.9% of the retail universe do not know how to trade at these levels. Okay, they don't want to be buying when it's most bearish. They don't want to see the market screaming down like this. Okay, because it's going to cause a fearful um, reaction in them. They're not going to anticipate the market moving higher. What will happen is that they're going to be anticipating a continuation lower based on uh, the previous market action. Okay. Now, for this moment, as we're discussing, it's not important that we understand what specific time frame we're looking at because it's applicable on all. So, as I'm describing this, until we actually talk about the ICT kill zones session specific, that being the London Open, New York Open, and London Close and Asian session, those are going to be dealt with later in the series. But for now, just understand the building blocks that make up this pattern and how we can learn to anticipate it in our charts. It's one thing to talk about it in an abstract form like this, because I get a lot of flack from folks that are not really willing to put the work into learning it or seeking out and studying it. They want an ABC, here it is how it happens all the time type of approach to trading it, and it's not going to be that easy. It took a lot of years for me studying price action to be able to identify this stuff in advance back here at this stage in during the initial consolidation, then expecting the run to support, and then the smart money reversal at the low. Okay, and then there is an accumulation, which is going to be the low risk accumulation buy. Okay, that's the first of the blue area on the overall profile. Then we have the next higher blue area. Okay, and this can be a little bit tricky. Okay, and this is where higher time frame directional premise is going to be advantageous for you. Okay, because this is the very area here that will many times, if you're wrong on your prognostication of on the higher time frame where the market's going, and higher time frame can mean as much as a 1 hour charts perspective if you're seeing the market maker profile occur on a 5 minute chart. So if you see that on a 5 minute chart, again, you're going to be referring to a higher time frame, and you may not necessarily be referring to a weekly chart or a daily chart. It could be simply a measure of 1 hour or 4 hour or even a daily chart. But you'll learn that it's many times not necessary to go beyond the scope of two higher time frames. So again, keeping in line with what we've done in the past, 5 minute is subordinate to 15 minute, which is subordinate to the 60 minute. And again, if you're seeing this price pattern form on an hourly chart, the hourly chart is subordinate to the 4 hour, which is subordinate to the daily chart. And obviously, if you're seeing it form on a 4 hour chart, 4 hour subordinate to the daily chart, which is subordinate to the weekly chart, and so on. I'm not going to beat it in the ground. You get what I'm saying here. But the fifth stage of the overall ICT buy model is going to be tricky for those um, traders that are looking for app solutions. It's going to have to be exactly as it's described here or conceptualized, and it's not going to always be like that. You'll see many times that the pattern itself will create a not a continuation long here, okay, or a reaccumulation, okay, which is described here conceptually. What it'll many times uh, provide us is an area for redistribution. Okay, much in the same area that we have in the second stage of the ICT buy model here. In this red area, once the move out of the initial consolidation takes place, this red area is when we anticipate another move lower down into an area of support, or what would be deemed an area of uh, buying interest. Now, again, we don't anticipate retail buyers. We're anticipating institutional, bank, large, deep pocket traders. Okay, that's the premise to what we're looking for in the charts. And I think if you're a new trader, I think if you're honest with yourself, you're thinking, what is everyone else on the forums looking to buy at? Because that's what their perspective is, and it's rather myopic. And I was the same way on America Online. I was looking for the guys that were going to be trading the cotton market and pork bellies when I was in futures, and can't trade pork bellies anymore. But nonetheless, I was anticipating seeing the views, if you will, of other traders. And I guess I was expecting, in honesty now, looking back, I was hoping that I would find someone that felt or seemed honest in their opinions or analysis, and I would just cling on them and see what they were going to trade. And I would look to do that. I never found anyone that was trustworthy. So, but I know looking back in retrospect, that's really what I was looking for. I was looking for someone to hold my hand, because it was a scary thing for me. I didn't want to put real money into the marketplace. So I know a lot of you folks that are just now warming up to my concepts. This is a higher level concept. It's not like, going in there and looking at, trend line breakouts. This is going to take a little bit of work and study. And this is one of the tricks to expecting, okay, failure. Okay, and I don't want you to come through this video series thinking that this is the panacea, be all end all to market analysis, and there's nothing that's going to be infallible. It's going to be perfection, from the beginning and to end. It's going to be plagued with times when you aren't correct in your interpretation of what price action is suggesting to you at that moment. And I'm telling you exactly where this is going to occur at. Okay. You may see the initial consolidation, the run down to support, the smart money reversal. Okay. And then a low risk accumulation stage in here where you buy and you see the reaction and you think, okay, well, it's going to be another reaccumulation in here and then move lower, I'm sorry, move higher to take out this consolidation, which is the classic clearing of the initial consolidation where stops would be resting above it. And it won't happen. Sometimes what will happen is you'll see the initial consolidation, the run to support, the smart money reversal, the low risk buy, and right up here it'll run a little bit higher just to make an optimal trade entry selling opportunity right at a pre-existing bearish order block that may reside inside of the second area of consolidation outside of the initial consolidation, or a return to the bearish order block from the initial consolidation that caused the move going lower. So in other words, this may look for all intents and purposes, look like a perfect ICT buy model, but in fact, way through, it changes gears and becomes a classic selling scenario. Okay, where you could be selling from an optimal trade entry at a bearish order block. Okay, and that again is going to be largely hinged upon your understanding of higher time frame directional premise. Now, if you are willing, and this is going to be a very, very big pill to swallow for most of you, if not all of you, if you're willing to accept being wrong, and I'll say that one more time, if you are willing to accept being wrong sometimes and not being concerned about being absolutely 100% right at this area of the profile, okay, you will still, it'll still serve you very well. You'll see a lot more insights that the retail universe generally doesn't grasp or doesn't get from looking at charts. And again, the the initial consolidation is kind of like what we learned already about crouching above a order block. Okay, and this area in here where we have a run to support, that is absolutely what you're anticipating. This is the consolidation above a existing order block, and then you'll see a move sharply lower into a support level. Okay, and then you'll see the underlying price actions moving higher and higher into each stage, and then ultimately clearing the initial consolidation where stops would obviously be building and resting above that consolidation in the form of buy stops, because those participants that would have been lucky enough to be riding this lower and unlucky enough to be riding it back up, eating up all their open profits, they will be neutralized here. Okay, what your mindset is, you want to be looking for this particular pattern. Okay, and now we're going to talk about some specifics. What is it that you're specifically looking for, or what should capture your eye or perspective on the market at any given time where this price pattern or fractal uh, should be forming? In other words, where should this particular pattern take place? Because it's one thing to see it conceptualized and abstractly shared like this, but you can't trade this. You can't see any price. You don't even know what price you're referring to in this. Okay. Again, it's very vague. It's very abstract, but you have to have a building point, okay, or a foundation to build upon. Then, as you see many, many sample sizes on a daily basis, on a weekly basis, of multiple asset classes, not just Forex. Okay, you should look at stocks. You should look at bond markets. Okay, commodity markets. Everything that's tradable, you'll see this phenomenon take place. Even Bitcoin. So if you see these patterns recurring over and over again, okay, this is what went through my mind. I would see the market move out of consolidations or trading ranges, drop down sharply, and then had this absolutely stellar bounce off of a level that made no sense to me at the time. Okay, but a week or two looking at the charts, I'd go back and say, wow, look at this thing. Back here, somebody knew this was going to go up here, obviously, and the participants that were buying it down there, I want to be a part of that group, and no one was teaching it. What I discovered initially when I was on America Online, I know some of you know that I'm very arrogant and pompous and egotistical many times when others challenge me in my um, ability as a trader. That's the old me. I don't like it being shown too much, but sometimes the old me just comes out. I know it may put off some of you, but I'm being honest, it's me, and I used to be a lot worse than that. But on America Online, when I first started making money, this is the late 80s, I'm sorry, not late 80s, late 90s. I was very proud of myself with what I was able to do initially. And I had entered a room where a teacher, and he admitted he hadn't been trading very long, but he was teaching his concept or understanding of Wyckoff. And when I got to the point where he was describing some of the terms about jumping the creek and breaking the ice, and it sounded hokey. It really did sound hokey, and I get why some of you that have watched my stuff uh, made fun of some of the things I described as, for instance, the Judas swing. I got a lot of flack for that, and I know what that's like for you to hear those types of things and feel that it's silly, so let's make fun of it because it doesn't make sense to you. That's the same thing I felt about Wyckoff, when you will see in a couple of minutes when we get to some of the concepts and theory that he was sharing. And this is old school stuff. This guy isn't like from the 90s. This is way back in the day. He had terms that he coined for the way he interpreted price. And I think that is one of the things that, as a new trader, and this is something that I did as well, we take it for granted that traders that are successfully um, able to dissect the market and discern what price is doing based on their own internalization of what price has done in the past. That is some of the strongest insights that you'll gain over time, and appreciation as well for what others are able to do in their interpretation of price. Not so much how do they trade, but how they digest, how they take in what the market's sharing, because we're all looking at the same thing. It's the same open, high, low, and close, but yet how is it that we have so many varying perspectives and yet still be profitable? Wyckoff, his theories, when it was first introduced to me, I just scoffed at it and said it was ridiculous. It's stupid. It made no sense because at the time I understood simply trend lines, moving average crossovers, stochastics divergence, and failing volume as price made a higher high. If volume was dropping down, volume precedes price. That's what I learned in commodities, and that is true. But you can't really discern volume in forex, so that's why we don't talk about volume in foreign exchange, because you're never getting the true volume. You're not seeing it. Okay, you may see it on your broker's level, but that could be in question as well. So we're not going to talk about volume, and I think it's rather pointless to even refer to it in the asset class of spot. But when we have our discussion about commodities, it will absolutely be essential because it's something you can be very sure about in terms of its measurement. But I just simply didn't have the faith of following or digging deeper into Wyckoff's material. And um, some of you that are reading and listening to this video that were around me in those days, I know a few of them have recently rediscovered me in the foreign exchange teaching circles, um, will remember me being very argumentative about everyone else's concepts and largely Wyckoff's at that time. It wasn't until I met someone on a institutional level that were sharing concepts on how they gauge accumulation and distribution on a institutional level, and it was basically largely hinged on looking for accumulation or consolidation, when the market drops down out of that accumulation area, okay, it would be a form of manipulation to gather either stops or to accumulate pending orders. And that was the beginning of my strongest understanding of how price action works. It taught me one of the most difficult lessons to apply to our trading is to be comfortable buying when the market's dropping aggressively. And it's a very difficult thing to do as a new trader, but I can assure you that's what you want to be doing. You want to be buying when it just doesn't feel right to be doing it. And the ICT buy model provides a basis or a foundation to doing that very thing. Um, and obviously, when we talk about the ICT sell model, it will be the same thing. When the market's just raging higher, it doesn't feel good to sell into that unless you have a foundation or a basis to hinge it on and why it would make sense to do so. So again, it's important that you understand that we present, or rather I do, present the ICT market maker profile, buy and sell models like I do. It's very uh, vague. It's a very simplistic perspective to hold on a market, but the don't discount its abstract nature, because it simply does get to the core of what price is doing. Because if you understand what each component of the profile or model is doing, or what it should be reflecting in price action, you'll be able to internalize what it is that the market is doing. Why is it gyrating where it is? Where should it go next? Because that's how we profit, right? It's not important so much what it's done yesterday or on the left side of the chart, in as much as it is going to be what it's going to be doing from the edge of your right side of your chart. We need to know what it's doing from that point on, okay? And it isn't until you do, months of study, not days, not weeks, months. It's going to be months before you can really sit down and immediately pull apart any section of price action and see these profiles. When they Once you see them and once you understand what you're looking for, you just can't just not see it anymore. You'll know exactly what it is that's going on in price action, and you'll see them very quickly. And you'll also be able to see them on a lot higher time frames, and you'll know, looking at certain price formations, that if you went down to a lower time frame, you'll see exactly what you would anticipate, either a buy or sell market profile. Okay, so let's dig a little bit deeper in what this profile can do for your trading. The building blocks really came from my first introduction to Wyckoff. And his idea was that the market will drop down and move into a consolidation where there is accumulation taking place. There is what we'll see here, and this may look similar to what has been described in a lot of my work as the Judas swing. Okay, uh, Wyckoff refers to it as a spring. Okay, it's a test to go lower, but it's quickly rejected. Okay, and I'm not going to teach Wyckoff here, because I do believe just the stuff I'm going to share, and it's probably only 3 slides in this whole series that you'll see from Wyckoff. They're the only things I think that are um, useful. Okay, and if you look at his work, you'll also discern rather quickly that he can describe it like this, but he's not going into a great level of detail on how you go into it and look for it live in your charts. Okay, it's one of those beautiful things like divergence. You look at an indicator in the past, they look at that, it diverged bearishly, and it would have been a perfect sell. But try doing that when you're in an uptrend and don't understand how that uptrend is performing in terms of where it is. Is it a new uptrend? Is it a mature uptrend? But even just simply because it bearishly diverged in an indicator doesn't mean anything. It could stay overbought for a long period of time and continuously make divergence bearishly and keep raging higher. And I actually got myself hurt a lot in commodities doing those types of things, just trading a stochastics divergence system and just not knowing what I was doing. So again, it's one of those things. Try not to be uh, too dependent on the the graphs I'm showing here because I'm just giving you a basis of how I got to the understanding of the ICT um, profile bull and bear. Okay, the buy and sell profiles. So Wyckoff's assumption was that as the market drops down, it goes into an accumulation phase. Okay, and many times it'll try to go lower and reject and bounce. Okay, and then this red line here for bullish scenarios, this is what he came up with as called the creek. Okay, and when it crosses that, it's called jumping the creek. Now I know it sounds a little silly, okay, and that right there, that was the very thing, jumping the creek and the spring. Those two things, I immediately dismissed it and paid no attention to it. I wish, in retrospect, I could go back in time and smack myself because I could have made fortunes well earlier than I have if I just would have spent more time looking at price action, because this would have spurred the insights I gleaned by looking at a particular market, and it was live cattle. Okay, live cattle. Okay, in 1997. Okay, 1997 is when I discerned in my own trading what this looks like, and I saw it just perfectly described as you see here, but I didn't see it with the understanding of accumulation, a spring across the or jump the creek, and they call it a throwback here. This is simply a retest. Okay, and then you move up rather sharply, and then go into a bull flag, and then a rally, and another retracement, and then continuation. The the point I'm trying to show here is that I didn't know how to digest what price action was doing. I was looking at this after the fact. Had no idea that during consolidations, that's where smart money was accumulating. What I was looking for was this thing right here, what's being described clearly right here, a breakout. I was looking for that to take place, then finding what we deemed as classic resistance turn support, then continuation higher, and then looking for what? Pennants, flags, symmetrical triangles, ascending triangles, all those types of things, continuation patterns, then looking for that, your trend line support going higher. That's how I traded initially. And then I discovered stochastics, and I thought I cracked the code and I was going to, own the world. That didn't work well. It made a little bit of money, but then suddenly the market turned around and it didn't work well at all. And you know what I'm talking about for those that have tried to be an indicator-based trader. The point of and the strength of what I gleaned from Wyckoff was his interpretation of what was going on behind the scenes. Because think about what's going on. If you can ascertain the framework of what's going on behind price, it doesn't matter, okay, that what's happened over here on the left side. You'll be able to digest what's going on as it's consolidating. You know what's happening. Someone's accumulating price. I'm sorry, accumulating positions. Now, you'll know quickly if we go below it in terms of breaking what would be deemed as support here. If it's quickly rejected here, and we're at a very higher time frame support level, or what would be deemed an area where it would be an interest for buyers. If we see that rejected like that, do you have to wait to be a breakout buyer here or a retest trader here? No. You don't even have to catch the very low down here. As long as you're inside this consolidation and the risk allows you in terms of your entry and where your stop loss would be realistically placed, you could be a buyer anywhere in this area and still be a participant in the subsequent move higher, which you would anticipate because of the accumulated positions during the consolidation at a higher level time frame support level or an area of potential buying interest. You would not need to see the qualifying or confirmation tools that we see with retrading back to a area of support resistance, bull flags in here. You won't need to see that. What'll happen is you'll start entering in areas of accumulation while it's in the consolidation. Then rallies out, comes back, gives you an opportunity, yeah, but many times you won't get this retest. It'll just scream against you, and then it'll consolidate up here. But would you want to be buying up here in contrast to buying, say, down here? What would be the more smart entry? Obviously down here, because your risk is limited to what you would discern below these lows versus buying up here. Where would your stop need to be? Who knows? If you put it below this low, it could still very well come back down deep and move into an order block that would be in this area here and take out this stop, or this layer, this level where stops would classically be building upon. Okay. And then, without going into further rabbit trails and such, I gleaned that this particular person had a way of understanding, again, broad-based, conceptualized, what's going on in price action. By having that understanding, that showed very well that I had a lack of that understanding. I was simply chasing patterns. That's what I was doing. When I was a commodity trader, that's what I was looking for. I was looking for classic chart patterns and no real understanding of what, trends were doing. I didn't understand it. I was looking for two perfect areas where a swing low would match another swing low if I drew a line between the two of it. And naturally, if it comes back down to that line later on, I'm going to be buying there. And that doesn't work. It doesn't work. Okay. I know 15 of you guys are going to send me 20 examples where it did, but I can tell you it doesn't hold up very long. I can give you examples of anything working for a little while, but what we're describing in this series is far and above beyond what is shared in books and texts and such. So I counsel you to, when you look at price action, come to the conclusion that you have to have a way of seeing what price is doing behind the open, high, low, and close. And I know that sounds rather vague right now, but when we start seeing some examples, you'll see exactly, rather quickly, what I mean by that. Okay. And when you start to do that with your trading and your study of price, you will get such a greater sense of confidence, because you won't necessarily be waiting for Gartley patterns and bat patterns and optimal trade entries. You'll anticipate accumulation, a break, and then distribution. Distribution, a break, accumulation. Okay, that's the whole basis of what ICT does. Okay, I'm looking for an area where strong buyers should come into the marketplace. How am I going to see that? Well, they're going to hold price in a small range. It's usually right above a bullish order block. And when price drops down to that order block, I know with absolute certainty that that is probably going to be one of the best buying opportunities of that particular time period. And I'll be all over it, assuming I'm awake. Caveat emptor. So looking at, what we're seeing here in terms of Wyckoff, it's, again, it's a rather vague conceptualized view of what price is doing. Can you look at this and say, okay, well, yeah, I've seen that 20 times in a price chart? Probably not. But when you have this idea as an example, then go into the charts and see when price had a strong rally out of accumulation or a consolidation like this, and see if it doesn't create these types of phenomenon. Okay, I shared with um, Chris Laurie's group. I was a member of his Pro Traders Club, his paid subscriber-based service. I was only with him for a couple months, but I was trying out his service, and I think it's a good service. But I shared a lot of the similarities between what I've learned over the years and what he teaches in terms of anatomy of a price swing, and the very strong not contrast, but the strong comparison between my market maker profile, Wyckoff's accumulation distribution cycle, and again, simply viewing the market in that perspective. And one of the essential strengths of Chris Laurie's teachings is that he makes it very apparent that while he is teaching concepts and ideas and such, he's leading the trader. And this is really what a lot of the work is done. You lead the trader to an area where they, on a personal level, internalize, digest, and view price in a way that makes sense to them. Okay. I view things in the form of they're out to get me, and I'm looking to snipe perfect precision entry points. When it's so loaded in my favor, I'm going to make money by default. That's how I internalize the marketplace. This another trader may look at this and say, okay, well, this is a casino, and this is what I'm looking for, and I'm going to play my hand when it's like this. That's their way of interpreting. Okay, does it make it any better that I'm an action-based, movies, movie show, perspective? Contrast that with the gaming theory of the casino. Absolutely not. There's no advantage over it. Okay, it just makes sense to me that they're out there to take my money, and the casino leads you to believe that you're in there to get money, and that's not what it's for. It's a business to take your money. Well, that's what this is. I view it as predatory. They're trying to be, a predator to my financial status. And by interpreting the marketplace with those ideas, it makes sense to me. Now, I'm completely aware that this may not resonate with some of you. It may not resonate with a lot of you, and it may be a sticking point for a lot of my teachings. And I'm okay with that because I'm perfectly comfortable with the potential for me not to adequately communicate this to a level where every single one of you readers and viewers are going to be able to digest it and use it. Okay. But those that aren't able to digest it and discern it now, I promise you, if you stay in the market and you look at price action enough, you'll come to this conclusion eventually over time because you already had the seed planted in your mind. Okay. Much in the same way I had it done in with back in my early days in White when American Lion, where Wyckoff was introduced to me, and even though I made fun of it initially, then the idea behind how he broke the market down conceptually, okay, not that it's a trading entry technique and it's a way to enter your trades. That made no sense to me. I could care less about that part. But the fact that he was able to, again, conceptualize something that was alien to me. I didn't understand what it is I should be viewing. Why should it rally? What are the precursors for a market that's going to rally? What does it look like? By having those ideas in mind, when you look at price, it's very advantageous. Okay, so let's continue on and look further into the building blocks of what led to the ICT market maker buy model. This again is just simply an image I snagged off of the internet. If it would have had credits, I would be able to credit them here. So if this is something you've seen before or know someone, or if this is possibly your image, um, I would have no problem giving you credit for it because I didn't draw all this business in here. But this is Wyckoff's logic as to what's going on. There is a selling climax that takes place, and notice here that this is what I saw a lot of times with the Wyckoff principles. All the examples that were shown in textbooks, and I have over 2,500 books now, either in electronic form or in printed form. And yes, it's a rather large collection. A lot of the regurgitated material you see in technical books and such, the reappearing images that are passed about generically. Um, with Wyckoff, it's no exception either. They'll always talk about the selling climax, Okay, then it goes into a consolidation. Okay, this is the spring, and then the test, the false break lower, and then it shoots back up. It jumps the creek here. Okay, this is the cause. The effect is the price markup moving into a buying climax, another consolidation, which is being distributed, and another test. Then it breaks the ice. This is the support called, again, silly names, I know, but that was his way of internalizing what was going on. And then the effect, therefore, seen in price being marked down. Now, again, this looks all fine and great. And again, with the same approach to using it like we look at indicator divergence, we all can go back in the left side of our chart and find perfect, pristine examples of bullish and bearish divergence. And that would be working perfectly, nailing the very high and low of the marketplace. The problem with it is you can't apply it real time. Many times a divergence may be there at the moment as the bar is forming, but then all of a sudden the indicator catches up and the divergence just fades away. I'm sure if you've looked at any oscillator, you've seen that occur many times, and it could stay in the overbought or oversold areas for long periods of time. What I was hoping to do was to take what this uh, uh, graph really is shown, and this is the one that I actually looked at, but I can't get a good picture from one of the texts I have with Wyckoff's picture that's very close to this. But the the idea was that there's nothing over here leading up to this area here. Like what? Okay, the selling climax. What was going on prior to the selling climax? That was the missing piece. Okay, and when I was introduced to institutional trading, I quickly learned that the selling climax is only important when it comes out of another consolidation at some degree over here. And you never see it in this description. So it's like one of those classic things. They give you a half truth, they give you a piece of the puzzle, but they don't necessarily give it to you in a way where it brings everything to clarity. Okay. And I think it's a measure of uh, shortcoming on their behalf, not so much that they're hiding it, because I don't believe that it's shared in any one text or any one course. Okay, and that's always been my um, goal, to be that one resource where we take what's available in the retail world and discard what's not really essential or useful, and keep those things that are useful. And I can show how using indicators, even though we've made a point of saying that divergence is not something that can be trusted, I can show you ways using something like what we're describing here and applying divergence with an indicator, and then suddenly it'll make sense to you. Okay, but you see the problem with it. We as traders, we were brought into the marketplace with the idea that indicators would be their easy way of getting in and out, buying and selling based on bearish and bullish divergence. And it can be said the same thing with support resistance. Well, clearly we can look at a chart and say, okay, well, look at this. It bounced at an area of support down here. And look, it bounced at an area of resistance down here. But were you able to ascertain those levels in advance? Because of the reoccurring question I still get to this day is, what level should I have on my chart? And if you haven't gone through all my work, you're going to ask those questions. Okay, if you've gone up to this point, you don't have any problem knowing what level to have on your chart. You know exactly which one you should have, or which levels to have, I should say. The idea of knowing what is going on over here prior to the selling climax, okay, it's not enough to simply say selling climax. Okay, you need to know it's in an area of consolidation prior to the drop down. Now, why is that important? What was the precursor for my breakthrough, if you will, about knowing that? Well, simply looking at ideas of selling climax. I was looking at 1 hour charts on Metastock with all of the commodity markets. And on a 1 hour chart, any intraday move of significance would be clearly defined by me at that time as a selling climax, because I was always trying to form fit and mash this idea into the marketplace, just like we try to force the divergence before it's really there. Okay. And I had no idea of anticipation. What I was doing was imposing my will, and you can't make money doing that. Okay. So it took a long time for me to allow someone with more understanding than me to kind of like remove the blinders I'd put on myself for many years, with the idea that classic chart patterns and simple trend analysis was going to be the answer to it all. And when I understood that the larger entities that are in the marketplace trade with a very generic repeating phenomenon over and over and over again, it's always there. Um, when they enter the marketplace, there are classic signs of that happening. And there are very clear confirmations that it was them that moved the market. Obviously, that's the telltale sign, because retail traders can't move the marketplace. You might create a small little blip here and there, but by large, it's really the institutional level traders that cause the significant moves from say this consolidation to this consolidation up here. You're not going to get that move by way of retail trading. So again, that was one of the small little things that came by way of staring at the charts and seeing some things, and then asking a lot of questions when I got involved with the institutional side of trading. Again, it's one thing you'll hear folks say, well, there's no real advantage for a guy that trades at a bank. Well, yes, there is. There's a whole lot of advantage, especially if you are uh, one of those traders that have been successful at learning these types of things. It's it's very disarming, okay, to listeners to say you don't need to be knowledgeable like those that trade on a bank level. But you're really, what you're doing is you're putting blinders on. You're saying, because I can't get to that information, I will assume that there is no advantage. And I'm telling you, from someone that's been on the other side, there is an absolute advantage to knowing how they think about price. Okay. Um, as we go through the examples, not simply this one here, but we're going to look at the sell profile as well. And at the end of the Market Maker 7, I'll give you a lot more examples of how we blend them together. We're going to hint at it here and give you a lot of things to work with before we go into the analysis and study concepts for Market Maker sell profiles, so that we can go into and look at your charts, and while you're waiting for Market Maker 7 to come out, you'll see that there's a simplistic way of looking at price that repeats itself over and over again, but it hinges on your understanding of what we're sharing here. There's accumulation that takes place. There's a break. Okay. There is a distribution. Then there's a break. Okay. What I'm saying is, you need to understand how I had to learn what price is doing behind the scenes, and not, now remember what I'm about to say, write it down. It's not important what price patterns you're looking at. That's not what's important. Price patterns by themselves are useless, and that includes my optimal trade entry. Okay. Order blocks are stronger than optimal trade entries. Why is it? Because it gets to the root core of why the price action is doing what it's doing, because you can trace it back to the immediate anchor point from which the price point of origin starts prior to its inception. Again, this is a crude depiction of a price move here, and again, it's an abstract way of looking at it. But let's assume for a moment that price had did a very similar thing like this, and moved in consolidation and moved out, made this price leg up. Okay, so we have an impulse move here, then we have a retracement. If price comes back down into this area again, okay, it's not hard to come to the conclusion that we may see a bounce. It may continue to go even higher, extrapolate. You have an extrapolated move higher. But even if it only bounces a little bit in here, if this is a 1 hour chart or a 4 hour chart, that could be anywhere between 50 to several hundred pips. Okay. But it's not that we draw the low to a high and anticipate the fib. That just draws an area of attention to see if there's a confluence of a pre-existing order block that would be lining up in that area. Okay, when you graduate to the truer form of price action, you won't even need the fib because you'll know by looking at it where the 62 and 79% retracement levels are respectively. But what your eye will be going to will be the original point of origin that is identified with the order block. Okay, the last down candle prior to the swing up in price, that's where the buying was done. It's not looking at the up candle or the consolidation range area and calling that the supply or demand zone. Okay, that's not what we're looking at. We're looking at specific levels. It's the actual high of the last down candle prior to the price swing moving up. Now, that's specific. That's not a range. That's not a zone. That's a particular level. Okay. And by having that level of precision that was shared with me, I've shared it with you over the last two teaching series, and I've seen a large increase in many of your understanding in many emails, many of the shared trades that you've made and commentary and analysis, and you've all surprised yourself. And it didn't require any indicator. But what it has shown is your understanding of what's going on behind price action. What's the footprint that's left by smart money? How is it useful to you at a later time using what's going on in the left side of your chart to know what to anticipate going on the right side of your chart? What I did was taken many of you along a very long, very, very tedious journey. And some of you are kicking and screaming, and some of you still are. The ideas of peeling back price action to get to the root cause of what's going on. Why is price in the consolidation? Why did it go up? Why is it dropping? What's it reaching for? Okay, all those ideas need to be internalized. And the beginning of that perspective came by way of my reintroduction to Wyckoff with a gentleman that traded on an institutional level. And between that and what's being shared here in the last few slides, that bridged the gap in my understanding of what goes on in price action and gave me at that time a greater understanding and appreciation for indicators. Now I have since evolved to the degree where I don't even look at indicators anymore, but if you want to be an indicator trader, this insight will help you to only look at indicators when it lines up with what we're describing here. Now, this is the last bit of business as it relates to Wyckoff, but I want to kind of draw your attention to, again, when we are in a consolidation like this, um, Wyckoff was teaching that there would be this initial attempt to go lower and then quickly rejected. Anywhere in here, you could be buying. Now, they're saying here that the positions are being built here. I'm telling you that they went down here to accumulate the buy positions. Okay, the textbooks tell you they're building positions here and here after the breakout. When markets drop down like this to take out old lows, we understand now that orders are resting below that. The institutional perspective that was shared with me was that's the purpose of this move down here. Now, the institutional perspective is not to say we look for this before we buy. Think about what I just said there. Okay, the institutional traders are not up here saying, okay, we're going to look for this move down here and be a buyer. They're up here saying, over here there's a low and over here there's a low, and this is clean. So there must be individuals, because we're higher than we were there from this point here to here. So they're in paper profit, those that are long from this level of what would be viewed as support. The institutional perspective is to say, well, I know there are individuals that are going to be interested in selling to me if I'm able to place a order down here. Now watch what happens. Assume for a moment there is a large pocket of liquidity resting below these lows. And just for easy way of describing it, say it's $1 million. Now I know that's not going to work well for most of you, but we're just trying to conceptualize something that it's impossible for me to share with you otherwise. Assume there's a $1 million liquidity down here in the form of what? Sell stops. Why is it sell stops? Because the market is bouncing at these two price points. At this price point up here, we're above it, right? So anyone that would be long from this level here would be in open profits or paper profit, unrealized gains, if you will. An institutional trader would say, okay, well, I don't want to buy at these inflated prices. They're already marked up in here. Okay, I want to get a lower risk area in mind to be a buyer. So what they're going to do is they're going to look at what's already happened in the recent trading and taking into account to what it is trading at the moment. Okay, again, we're assuming that this price move has not happened yet. Okay, as prices up in this area, the institutional trader will say, well, I know there is an open interest to be sellers below these lows. Why? Because the market's higher from this price point from here to here. So therefore, longs are in the market here. They want to protect their position. How? They want to put a sell stop or sell stops below the low. Now, they are saying by having that stop in the marketplace that they are willing to sell at this price. In fact, they're in uh, a strong desire to be a seller at this price. There's a very large motivation factor for them to be a seller here. Now again, say there's an open interest or float of $1 million in terms of sell stops below here. An institutional trader down here at this price point would say, okay, well, I want to accumulate those orders that want to sell because I want to be a buyer. They see this accumulation sideways as the precursor to the price move that's going to ensue higher later. But they don't want to buy it up here. They want to get it at a lower discount price. How did they do that? They will put in orders to be a buyer down here on limit. Now what will happen? You have $1 million. Again, this is just, again, don't focus on the number. Just think about it conceptually. The market is already at the top of the range in here. There's going to be a drop in buyers. So what will happen is there won't be any more buying in here. The market is predisposed to be a seller. Okay, the market's always in the business of selling. Whatever asset class it is, it's always a sell, sell, sell market. Okay, if there isn't a, if the buyers are abated, there's no more interest in being a buyer here. What's going to happen? The market's going to seek the liquidity that's resting in the market. What is it going to do? It's going to see the noted lows here and the subsequent sell stops below it, and the interest of buying on a limit down here. So the market will do what by default? It will pair those orders together. The market will jump to that liquidity area, fill those orders, and those participants up here with the institutional perspective will have these individuals that were long unseated buying at a lower price better than they did here, and then be in position to ride this move higher. That's the institutional perspective. You don't see that being shared with Wyckoff. You don't see that being shared with the classic breakout scenario retail stuff you see perpetuated in the marketplace. What I just shared with you is what was shared with me, and I was asked not to share with anybody, but I'm retiring and I don't care at this point. So, and I don't sell anything. So now you have the institutional perspective, and it didn't cost you anything for, out of your pocket, except for the time that you've spent so far worth my material. So now, when we talk about pairing of orders, that's what we're discussing. That's what we're saying, and it comes in a lot of different forms, but that's how it operates. And let's go further so we can understand with a greater degree of what it is that we look for, how does it take place, and bridge the gap from what Wyckoff was unable to do and apply what I learned from the institutional side of trading and price action. And then we're going to now view the ICT buy model. Now, again, I can pretty much promise you that the first time you saw this, you were like, well, what is this? This is Mickey Mouse. This is this is absolutely nothing that's going to be any use to me. And I remember the first time I scribbled it out on a notepad, and I was thinking to myself, you know what? This this overall price structure reoccurs over and over and over again. And I needed to come up with a way that definitively outlined the things that I expect or should I be expecting in price action and learn to anticipate at each stage of the profile. Now, before we go into any great detail, it's important that you understand this. There's only three major components that always take place in this fractal. It's the initial consolidation, the reversal point, and the clearing of the initial consolidation. That's a completed buy profile. Okay, those 3 points are the only ones of interest that make always the case for formation. These price points in here, the move from this secondary lower consolidation down into the reversal point, and then the initial low risk buy, and then the reaccumulation in here. These areas are what would be the most subjective of the profile. And these are going to be the sticking points I already know, because many times I see this profile with one or two or all three of these particular components of the fractal not in, or not in a way where we can clearly see it or use it at the time in real time. Okay, but we can see accumulation, a drop down, moving into a support level, and then a rapid move away. Okay, and what I'm saying is in these two particular price points, from the reversal point to the clearing of the initial consolidation, this may be so fast and thin, okay, or little to no retracements or pausing, that you would assume that it's probably not a buy profile, but in fact it still is. Okay, because what we're really describing here is what? A consolidation, accumulation, a tripping, so we can buy lower, okay, or smart money buys lower at the very point of reversal, and then they distribute those longs that they accumulated here at this price point here. Initially, this is a hedge. They're buying to hedge. Now they're buying for speculative gain down here, and they clear it here. So the hedge is now complete here, and the net long positions they accumulate down here are distributed as well. So that's the overall fractal pattern or premise behind the formation of what we are describing here. The other, again, the other caveat emptor here is that this particular area here, the reaccumulation, may be in fact a redistribution. Okay, from this consolidation, this price moved lower. It may be just moving back into a pre-existing bearish order block to go lower, and your idea of seeing a buy model may in fact not be true, and then it may continue to move lower. Okay, but let's look at what it is that you would expect to see as you study price action. Initially, without any question, you have to have a discernible level of resistance, or what we would view as a bearish ICT order block. One of the two. It could be a discernible horizontal resistance, or it could be a old high. It could be an old low. It could be um, just a higher level, a higher time frame bearish ICT order block. Okay, so I'll leave that to you, because again, this fractal takes shape by way of first finding an area where we would anticipate an inability to go higher, and we see that with this consolidation. And then when we see this drop down, it's not that we're looking for consolidations in a drop and then I'll say, well, the next time we go down to another leg, I'm going to be buying that. That's not what we're saying here. Down here at this reversal point, there has to be a level of expected support and or a bullish ICT order block. So now what we've done is what? We framed the market between a level of anticipated resistance. Once we see the reaction and we see that happening, price comes down to a predetermined higher level support. Now this can again be an ICT order block, bullish order block. It could be an old high, an old low. It could be classic horizontal support line. Okay, that again, I'm going to leave that up to you to discern what that is, because there's so many variables that could present itself in the form of support and resistance. Just know that ICT order blocks and horizontal support resistance and old highs and lows are basically the same thing in view of support and resistance. So we have to have that as our uh, basis between what we anticipate seeing in price and what we anticipate uh, unfolding at a future time based on these two price points. We have a resistance, finding support, and then we would anticipate this phenomenon taking place. Now, once at this point now, you're probably saying, oh, there it is. I understand it now. It's simple now that I can see what you're saying. But not having the understanding of what we described earlier in this video, okay, it probably would have escaped you even with what I just showed you here. But see the difference now? We've already identified the fact that when we move in consolidation, what's going on here is there are buyers even up here at this level of resistance. They're buying early. They're buying even more here, okay? And they're buying ultimately a lot more down here, which causes the reversal. There's a shift in, and I'm going to say it, demand, okay, where the supply is no longer greater than the buying interest. So this level down here, whatever it be, whether it be a bullish order block or horizontal support or an old high or low, this area is viewed as a very extremely undervalued price point. And undervalued price points don't remain intact very long. They quickly move back either to equilibrium or they get inflated to a price point that's far above what's expected as norm. So now we have a framework to anticipate how these fractals form. We have a basis to uh, learn to anticipate when they're going to form, and also with the very clear area of where we'll see them fail. If we see a resistance level, a drop down, find support, and starts to rally up, okay? If we are in an area where we'd anticipate a market that's going to move higher, in other words, if say this pattern is unfolding on a 15-minute time frame, ideally on a 1 hour and 4 hour chart, the market should be in a bullish stance where we should be expecting higher prices on those higher time frames. Again, we're going to look at the two higher time frames from the time we see, or time frame that we see this potential pattern forming. And again, for an example, let's say this is a 15-minute chart. Again, we would see ideally a 1 hour and 4 hour chart in a bullish, uh, you know, uh, market structure or stance to move higher. In other words, we would see like the moving averages 18 and 40 and 9 and 18 stacking and opening up, pointing higher. And then if that's the case, the 15-minute market maker buy model that we're describing here should in fact see reaccumulation here and not a retracement back into this consolidation to make a sell, it would be a reaccumulation for new longs to go higher and clear the initial consolidation. Okay. All right, so now let's look at a section of price action, and this is the Aussie Japanese yen. Now, I went and selected this particular pair because in my opinion, it's an exotic, because it's crossing two pairs. I don't trade too much, and I want to be able to show you that this works not just in my two pet pairs, the fiber and cable. Looking at price action like this, it may escape you what's being shared in the actual price action. But if we understand what we've already described earlier, if we start adding some of the building blocks to this particular segment of price action, one would quickly come away with that you have a area of consolidation. After this area of consolidation, we see a small little price move lower, and then we move into another consolidation, which is followed by what? Another move lower, and then we find an area of reversal. Notice the area of reversal down here comes by way of first clearing out these equal lows. Okay, so now what do we have here? We have an area of predetermined support, okay, a liquidity pool, which we understand by earlier videos in this particular series and other subsequent teaching series by me. We have the consolidation of another move lower or run to the support. We have the reversal price point, the smart money reversal in here. Okay, will we anticipate what after that? The low risk buy, moving back into what? This low here, this down candle prior to the move up, this is your bullish order block. Price moves right back into it right here. Okay, this is the low risk buy. What would we anticipate after this area of consolidation? A break higher, moves into another smaller consolidation. Now, if this was in a bearish market environment, this could very well be just a retracement to go lower. Okay, but we are going to look at this segment in price action and see that it's in an area where we would anticipate higher prices, and where we would anticipate it to move. Our original consolidation is here. We're going to look to see that area cleared, and that's what we see here. Price comes above this area here and then moves into another consolidation. Now know what you're thinking. It went higher, Michael. This is only giving me an area where we can anticipate a low forming here, maybe buying here, maybe buying in here, just to get an area to move here. Well, that's enough to make a weekly objective of 50 to 75 pips. And that's what I teach traders to try to strive for, not try to hit home runs every single time you get into the marketplace. This segment in price absolutely has nothing to do with our teaching here. This will all be described and explained when we talk about trend trading and target analysis with specific trading approaches that in our last 3 trading videos of this series. But now looking back at this same price segment, let me ask you a question. What other fractal patterns do you see in this particular segment of price action? We've already outlined the buy model here. Okay, but do you see any other price patterns? We have a low, a rally up to old support, broken, turn resistance, comes right back down into that order block. Here is the Asian Open, which is going to be one of the hot spots, if you will, for this particular pair, because it is a market that's both Aussie and Japanese yen are very active during the Asian session. So now looking at price, you'll see many times that are highs and lows that are very strong, or in other words, we get very respectable uh, reactions. They'll occur during the Asian session for the Aussie Japanese yen pair or the Aussie versus the dollar, or the Japanese yen versus the dollar, or dollar yen rather. So Aussie dollar, uh, dollar yen, and Aussie yen are predominantly in an Asian session a pair. So if you're interested in trading Asian session, which I don't do too much of, um, this is one of those pairs that serves you well. The London Open in here, you can see the other price pattern in here coming down into a bullish order block, optimal trade entry, and this was an optimal trade entry. I failed to mention that here, sorry. We have an optimal trade entry in here, which now think about what we've already described. We've described these areas in the market maker buy profile. Okay, so what we're doing is now we're adding another level of understanding and perspective to make this information more useful to us. Okay, and then this buying opportunity that was in the London Open carries us into what? The New York session. Now, we've seen two buying opportunities in the same day. Rarely, if ever, there's three. So when we moved into the New York session, moved up into a level of resistance, institutional 92.20. And if you've seen my old work from 2011 and 12, the market reversal profile where we see the high form or the low form in the New York session or London close. And that's what we've seen here, which comes by way of what we'll learn later on, because I'm actually going to use all of this same price segment to teach the market maker sell profile, which I'm just going to give you a hint about in here. That is what this price pattern is here. This is an ICT market maker sell profile. Wait a minute, it's an ICT market maker sell profile and it's a buy. That's what this is as well. This is an ICT sell profile. Okay, market maker sell profile here, and this is a sell profile here. And I know you're scratching your head thinking, wait a minute, that doesn't make any sense. Well, I got another one for you. This low to this high down to here is a market maker sell profile. And yet it's still a buy. Remember what I was talking about? There is that second stage of either reaccumulation or redistribution. That's always going to be the sticking point if you do not have a higher time frame perspective in mind. The market maker sell profile, which we'll deal with a lot in number 7, like I said in the beginning of this video, I was going to touch on it. The sell profile is just the reverse of what we described as the market maker buy profile. The accumulation or consolidation starts in here, which if we go down to a lower time frame, and we're going to do that in a moment, the lower time frame in here, we'd see consolidation, a rally up, a retest, a rally up again, reversal, come back down into what? We're going to see what? A redistribution to go lower? No. It changes gears and it's a reaccumulation. Then it becomes a continuation pattern. Why is this sell profile that we're going to see on a lower time frame 5-minute chart, why is this a buy signal, but yet it's inside of a market maker sell profile? Why would I call this a market maker buy model? Because what I described earlier, when we get to that second stage towards the completion of the overall fractal, we don't know unless we have a higher level time frame perspective in terms of directional premise. Where is it most likely to move on a higher time frame? That's when we can see the latter stage of the fractal pattern forming the either redistribution or reaccumulation. Now I know I probably confused you, but we're going to go in and look at these two instances right here and see how that works within the overall market maker buy profile here. But inside of the overall buy profile, there's still ICT market maker sell profiles that become bullish. Okay, so I know I probably confused it, but let's go into actual price charts and you'll see a lot more clarity. Okay guys, we are looking at the Aussie Yen pair, and I have price action that's on a 15-minute time frame shown here as well. Now, that fractal pattern that we just looked at is essentially this movement here and then up here, okay? And that was the overall price action, and the fractal actually ended over in here. We didn't show any of this appreciation or move higher. What I want to draw your attention to is we have the 91 big figure and the 90-80 level. Okay, so these are institutional levels that we like to watch just to see if there is any confluence for support or any kind of buying or selling interest around these particular levels. And we are on the 15-minute time frame. And I want to ask you a question. As price moved away from these levels, was it slow and lethargic, or was it pretty responsive each time it traded to it? It's pretty responsive. Okay, so overall price is being accumulated at these particular price points. Now, it's not important, and it's actually a better thing to not see price return to a level multiple times, because you want to see it start to have an inability to trade lower. Okay, and that's really what we're going to build upon on this example. We had, and let's put the markers in here for delineation. We had price action. In here we had a consolidation, a move lower. Okay, found a low, rallied off, came back down into the down candle prior to the move higher. So we have a bullish order block retested here, and the rally off, a reaccumulation, price makes a move, clears out the initial consolidation in here. Okay, there's your overall buy market profile. I stated inside of the overall buy profile that we would see a sell profile. That is in here. Okay, because we have a consolidation, a rally up, a distribution. Then there's what? Is it a redistribution in here? No, it's a reaccumulation. Accumulation of longs that led to this move higher, they reaccumulate again, descended higher. So while we have a higher time frame market maker buy profile from this consolidation moving lower, okay, this area or segment of the overall larger fractal, okay, the buy profile here, inside the buy profile there is a sell profile that is still utilized in a bullish capacity. So let's just bring a little bit more light to this example. I'm going to highlight this area right in here. Okay, and what we're going to do is we're going to drop down into a 5-minute chart. Okay, so now we have a consolidation in here. Price rallies out of the consolidation, and what does it do? It comes back and retests this area of consolidation. Then it rallies off again into an area of what? Old resistance. Okay, and again, I'm giving you insights on the market maker sell profile, but we'll build a lot more detail like we did with the buy profile. In this segment, we'll do that with market maker 7. But price starts to trade off and comes back down into the original consolidation. This is where we would anticipate in the sell profile to rally up and redistribute and go lower to clear the initial consolidation. But because we are in a larger buy profile, this sell profile on a smaller time frame, so it's a fractal within a larger fractal. It's a selling profile inside of a larger buy profile that is used in conjunction with the overall larger buy profile. This sell profile is useful to us that we can see an entry point that also dovetails nicely with the overall buy profile. And we could be a buyer right in here at the 91.15 area. Price makes a move lower down to around 91.10. Even gives us our optimal trade entry in here. Why is this important? Because now we have an overall basis or premise to anticipate higher prices. The overall bullish scenario, the inability to get down to that 91 big figure after we've seen several attempts to see it rally off. This is a good indication that it wants to go higher because it was unable to go back down to that 91, and in this attempt to go down lower didn't see it again, okay, which would be indicative of our market maker buy profile as we outlined just a few minutes ago. And then price continues to move higher. So we have an opportunity to see the sell profile dovetailing very handsomely with the overall buy profile. So we have a sell profile inside the larger scope of a buy profile. So we have a pattern within another pattern, a fractal inside of another fractal. Okay, we see the same thing happening here. We have a consolidation, a market maker buy profile. We have a run to support. Okay, we have a smart money reversal, and then we have a low risk buy, rallies off, a reaccumulation, rallies up, clearing the initial consolidation up here. There's your market maker buy profile. Look closer. In here, we have a consolidation. It rallies up into what? An area of expected resistance. What would that be? Bullish candle prior to the move lower. Bearish order block. Sell. Market maker sell profile. A retest, failed, comes down. Redistribution, comes back down into what? The initial consolidation or bullish order block. Down candle prior to the move up. Draw that out in time. There's your reaccumulation, not your distribution, reaccumulation, or a buy with a market maker sell profile in the larger scheme of a market maker buy profile. The same thing we just outlined here with this buy profile is seen here. You see what I'm showing you? It's a blending of the two profiles together. It's finding a pattern within another pattern, okay, and overall it just adds more clarity and it gives more strength to the overall market structure that you're looking at. And there you have your appreciation in price action higher. So it's important that we bring it back to the nature of seeing an anticipated resistance or support level, having a higher time frame premise in mind. That will be a barrier for you to not fall victim to the market maker profiles not working out in your favor. I'm showing you how to use them here, so that way when you're looking at your price action segments and portions and fractals, they will have a lot more meaning to you and not just look for patterns for pattern's sake. Looking for the overall distribution, accumulation, and the markup and markdown of price seen with those breaks from each consolidation. So I hope this has been insightful to you. If you're a little still unsure as to what we're referring to as market maker profiles as the buy, it will be further amplified in the sell profile segment in Market Maker 7. Until then, guys, I wish you good luck and good trading.